Thank you so much, Guillermo, and thanks, Siamak and all the other organizers of this conference. For the first time, I'm actually speaking rather than organizing it. We typically use this room for our digital finance seminars. And let me discuss about this paper, which is joint work with Brian Zhu, who is a PhD student in IOR. I think he's around. And with Teresa Zhao, who is a former graduate student from IOR. Okay, so I'm going to briefly recall what the decentralized exchange is. I think we all know, and this we have also seen it earlier in the conference, that basically it's a pool where liquidity providers or market makers are depositing assets. In this case, these assets are referred to as tokens, and they receive pool tokens in exchange to prove their share of the pool. So essentially, after they deposit, they become shareholder of the pool, and they're entitled to receive some fraction of the wealth of the pool, depending on their participation. So if there are, let's say, 100 token A and 10 token B in the pool, and the liquidity provider comes and deposits 10 token A, 1 token B, he has to deposit according to some pricing formula, so he has to maintain the ratio invariant in this case, and he's basically holding 1/11 of the entire share of the pool. That's basically the mechanism, and everybody can be a liquidity provider. Now, then there is the demand side of liquidity, which are investors or traders who swap tokens, and they get a fee which is proportional to the amount of tokens that they are swapping. For example, if a trader wants to exchange token A for token B because they need token B, then they will pay a fee which is proportional to the amount of token A that they are swapping in. And this fee is basically used to generate revenue for the liquidity provider, because this fee amounts to having additional token A in the pool. So instead of depositing 10 token A and 1 token B, they deposit 10 token A plus 0.03%, for example, the amount of token A that they are depositing if the fee is 0.03%. And this fee is exactly providing incentives for liquidity providers to deposit because they are earning the fees. The pricing is decided by a function which is called the automated market maker, and it's essentially a smart contract which implements an invariance relation. So if we have a certain number of token A and token B in the pool, if the inventory of the pool consists of 10 token A and 10 token B, and the amount that are swapped is 5 token A for some token B, if some token B for token A, you deposit in token A and you get out token B, and the relation is basically determined by this pricing curve. So if you basically add 5 tokens to the pool, then you basically extract an amount of token B, which is 3.33 in this example, which means that you have to land on this blue point of the curve. So this pricing curve is basically capturing also the price impact of the trade. If you are depositing 5 token A, you are not getting back 5 token B. You are getting back less token B, precisely because you are paying a price impact for the trade. Okay, so that's the algorithm. And I mean, the convexity of this curve determines the price impact. Like if the curve is linear, there is no price impact because you swap 5 token A for 5 token B. But because there is convexity, you pay a price for which captures the impact that you are creating when you trade. And depending also on the depth of the pool, the price impact could be lower. So if you have a very deep pool, which corresponds to this green, yellow line in this graph, you see that if you trade the same quantity, you will pay a smaller price compared to when you have a shallower pool, which corresponds to the blue curve. So just to recap, convexity of the pricing curve and depth of the pool are two key determinants of the price impact of the trade. Okay, so now what are the risks of liquidity provision? I mean, one of the risks is the so-called sex-dex arbitrage that has been discussed a lot and studied in many papers. Like, I mean, most of us or some of us have contributed to this literature. So the idea is that if there is a change, for example, in the centralized exchange, so the price of one token compared to the other change, so token B is now twice more valuable than token A, then what arbitrageurs can do, they can trade in the centralized exchange and try to realign the prices, and therefore swapping the most valuable token for the least valuable token in a way that basically the price is realigned, but in the process of executing this trade, they will basically end up earning profit because they will be able to get the more valuable token B for the least valuable token A, and even if they have to pay a fee for trading, this might still generate profit for them. So this basically is an arbitrage that creates a problem for liquidity provider, because when you execute these trades, who is earning, of course, is the arbitrageur, but who is losing is the liquidity provider, because now the liquidity provider is being left with a pool which contains less valuable token and Okay, thank you.
Your talk was so good that they put the fire.
Yeah, exactly. Thank you. Or the opposite. No, yeah. Yeah. Maybe the opposite. Yeah. So the idea is that basically, as I mentioned, this could be a problem. This is a problem for liquidity providers because they are essentially being extracted the more valuable token and be left with the least valuable tokens. And this basically has been also discussed extensively in the press, but also, there have been models, for example, in a former paper with Rijay, we basically studied exactly the loss of liquidity provider, the fact that when the liquidity provider is losing, they want to withdraw money because they're worried about being arbitrage, but then the liquidity of the pool will go down. This means that the price impact will go up because if you have a shelter pool, the price impact increases, it becomes more costly to trade and so on. And then this can even end up in a liquidity freeze where nobody wants to deposit in the first place. So instead, the topic of this paper is about the coexistence of passive and active market making, whereby passive market making, we basically mean the fact that the price is changing, the liquidity provider is depositing in the at the very beginning in the pool, and then trading happens. And they deposit before observing the order flow. So they don't know yet who will trade, but they will just deposit tokens in the pool, and then trading will happen. Now, how can one reduce the risk that these liquidity providers are being arbitraged, like what I've shown in the previous slides? One possible or potential solution is the just-in-time liquidity approach, which basically means that instead of being passive liquidity provision, now we have a more active form of liquidity provision. What active means here, it means that liquidity providers are not depositing at the very beginning and then wait, but rather than observing the order flow pending in the public memory pool of a blockchain, and then they sandwich an order with liquidity. So they basically decide to provide liquidity so that this order is executed, and then once the order is executed, they take liquidity out. So basically the mechanism is very similar to the one that some of you might have seen when you have a sandwich attack, but now it's not really an attack, but you're sandwiching a trade with liquidity. So you're adding liquidity, then the trade will execute against this additional liquidity, and then you take liquidity out. Okay, so that's basically the main idea of this active liquidity. And if you want to see it in the data, we see, for example, like taking this graph from Kaiko, that there has been quite a few attempt of providing like just-in-time liquidity. So this corresponds, if you want to identify it in the data, you see a mint and a burn, which is more or less of the same size. This corresponds to liquidity, basically just-in-time liquidity trade. And now let's start analyzing whether or not, this is the main question. And yeah, so as I mentioned, like whether or not this is beneficial for the market. In principle, at first it might say, okay, maybe it's good because there is more liquidity, or maybe it's not good because perhaps this liquidity is only consumed by the just-in-time liquidity provider. And the idea is that, to study this question, we have to create a model. And one of the characteristics of this model is basically exploiting the second mover advantage of just-in-time liquidity providers. So most of the times, in finance or in economics, there is always a discussion about first mover advantage. Here, instead, what is important is the second mover advantage, the fact that the just-in-time liquidity provider can move after they've observed the order flow instead of moving earlier, which resembles a little bit the behavior of high-frequency traders. It's different in that sense, but the question is that, the analogy that I find with high-frequency trading is that in that context, you have also the phenomenon of cream skimming, which basically means that faster market makers, or those who have access to information first, they might end up attracting the good orders, which is the cream of the milk, and then the bad part of the milk goes to the slower market makers, like those who get the adverse selection. And let's, there is a large number of papers on DEX designs that, some of the people in the audience, including Siamak, have contributed to, and I will skip it for the sake of time. I will just go to the model. So we work with an AMM pricing function, which is basically a generalized version of the constant product function, where we allow a range of trades happening between A and B. So you can provide liquidity between A and B. These A and B are fixed. So if A is equal to 0 and B is equal to infinity, this becomes the constant product function used by Uniswap. The rule that needs to be obeyed to determine the price is that the value of the function before and after the trade has to be equal to a constant. So if you trade QR risky coins for QS stable coins, R stands for risky and S stands for stable. That's the type of the two tokens that we are analyzing. Then the ratio, the relation must be invariant. And the fees are being paid and earned in a pro rata basis by the liquidity provider. So if you have a larger share of liquidity providers, they will end up making more from the fees. That's the game. We basically build a game theoretical model consisting of 5 stages. Passive liquidity providers arrive, deposit. Then in the second period, there could be either a trade executed by an informed trader or an uninformed trader. Then JIT providers will arrive. They will decide whether or not they want to JIT the transaction. If they JIT the transactions, they will deposit and withdraw all within the same block. And then there will be the realization of the shock. So if there was an informed trader, the price will move to the new fundamental. And this is basically capturing exactly what the informed trader had forecasted already in the second period. So first period, as I mentioned, like there are these n passive providers which are depositing coins. Let's say EP and is the amount of stable coin that the amount of risky coin that they deposit. P times EP is the amount of stable coins. So P is basically the value of one stable coin in units of the risky coin. So that's the numerator that we use in the model. So if we aggregate all the liquidity, like we sum all the deposits, we end up with the total depth of the pool. Second period, there is an informed trader who can come and he will arrive only with probability alpha. So it's not clear that there will be an informed trader. He will arrive with probability alpha. And he has perfect information about what the future price will be, what the price at 5 will be. So this is an extreme version of an informed trader who knows exactly what the price will be. If he has some signal which is correlated with the fundamental, then this shouldn't change the results significantly. So this is just for the sake of illustration and simplicity. We assume that he knows exactly what the price will be. And what he will do, he will choose to swap either the risky coin or the stable coin, depending on what his signal is. If he knows that the stable coin will appreciate in value, then he will swap risky coin for stable coin. If instead he has a good signal about the risky coin, then he will do the opposite. He will swap stable coin for risky coins. Then he submits this order to the public name pool. The other possibility that we can see in the second period is that there is an uninformed trader arriving. So with probability 1 minus alpha, there will be an uninformed trader. So the uninformed trader is basically a trader who has a preference for either risky or stable coin. He might have preference for stable or risky. Depending on his private valuation for risky or stable coin, he will decide how much he wants to transact. And the preferences are captured by these quantities, which we denote by zeta u. And zeta u is basically capturing, it's a reduced form model for the sensitivity of the order flow of the pool to the order flow. So in a sense, when an uninformed trader comes, depending on what is his preference or valuation for one coin versus the other, it will basically trade more or less. And this is captured by this parameter zeta u. So for example, if he likes the stable coin more than the risky coin and this zeta u is large, then he will basically swap more stable coin for risky coins. So third period is when the JIT arrives. The JIT trader, he will arrive. He doesn't arrive with probability 1, he arrives with probability pi. And upon arrival, he will decide whether or not he wants to deposit risky coin or stable coins. Then he will basically have to deposit again in the ratio given us by the numerator, which is basically one risky coin is worth P times DJ stable P times P stable coin. So if he deposits DJ risky coins, he has to deposit P times DJ stable coins into the pool. And then he will deposit and withdraw between the trader swap. And he submits this order to the memory pool of the blockchain. Period 4, the trades are settled. And period 5, we see that if the trade was driven by information, if there was an informed trader, then the price will adjust to the new value. So the fundamental price of the risky coin will adjust to this new value P prime if the trader who was informed arrived, which means there was an information in the market. And this will happen with some probability psi. So that's the probability that the same probability that an informed trader. Good. I mean, if instead there was an uninformed trader arriving in period 2, then there is no change in the price of the risky coin, so it remains fixed at P, so one risky coin is worth P stable coins. The reason is that even if there was a trade that moved the price, we can say that there is a reverse arbitrageur which executes the opposite trade, and therefore the price will be there, and the arbitrageur is making this money. Okay, so now that we have described the model, I want to describe a little bit the results. So the first is to write down the passive, the liquidity provider's utility function for the passive provider. So there are two quantities here. One is C, and the other one is R of pi. So C is basically the adverse selection cost, the cost for being adversely selected by an informed trader. So the passive provider, he deposits before observing the order flow. So if there is an informed trader, this informed trader will basically adversely select him. So and C is capturing exactly the expected cost of being adversely selected. So it depends on all the model parameters here. I'm just writing C to avoid writing down the full expression. R of pi instead is the expected fee revenue for the passive provider if it's depositing liquidity and if there is an uninformed order coming. So the expected fee revenue per unit. And the argument is that when we ask the question, okay, what will be the criterion for passive liquidity provider to deposit? Well, it will only deposit if there is this condition which is satisfied. So if the expected cost, which is alpha C, which is negative, plus the benefit is larger than 0. So if the benefits, the expected benefit exceeds the cost, then it will deposit. If the expected benefit is lower than the cost, then it will not deposit, because otherwise the cost of being adversely selected is larger than the fee revenue that is extracting from the investors coming and trading. Okay, so that's the idea. So now we end up like understanding a bit more how we can quantify the benefit of just-in-time liquidity provider from the point of view of the passive liquidity providers, or from the point of view of the entire agent in the ecosystem. To do that, we basically want to discuss two potential effects that can arise. One is what we call crowding, and the other is what we call complementing. So in economics, crowding corresponds to substitutability, and complementing is basically complementarity. So we want to see whether or not the actively or the just-in-time liquidity providers are complementing the passive liquidity providers, or they are substituting them. So they are substituting them if the revenue, when there is 0 probability for a just-in-time liquidity provider arriving, which is R0, is larger than R of pi. So that means that passive liquidity providers are getting more when there are no just-in-time liquidity provider. In that case, we say that there is a crowding situation. Instead, if it's the opposite, which means that the revenue of the passive liquidity providers, if there is no just-in-time liquidity provider, which means pi is equal to 0, is smaller or equal than the revenue of the just-in-time of the passive provider when there are just-in-time provider, then it seems that we are in a complementing situation. That means that the active liquidity provider, the just-in-time providers, are actually leading to higher revenue also for the passive liquidity providers. So which of the two regimes arise will depend on some market conditions. So in other words, if we want to describe what I just said in a picture, we can think of two possible situations. The first is that there are only passive liquidity providers. They are getting 100% of the pool, so 100% of the fees goes to them. Second situation is that we have passive and active liquidity provider. Now, when do we have complementing? We have complementing if the following situation happens. So active liquidity provider, which are these just-in-time liquidity providers, they are basically crowding in a way, they could crowd or complement the passive provider. So suppose that the active provider are providing 70% of the entire liquidity in the system because they are pumping up this liquidity after observing the order flow, and the passive liquidity provider are only left with 30%. Now, what could be the case is that it's true that the passive liquidity providers are left with 30%, but it's possible that the pool is growing a lot. So the pool is sensitive to the order flow. So that means that if, for example, there is more liquidity, it can be that more investors will trade. So if more investors will trade, the total fee that is generated is larger, which means that the pie is getting larger. So the passive provider are getting 30% of a much larger pie, and this 30% of a much larger pie is better than 100% of a smaller pie. So that's basically when we observe the complementing effect. Crowding is if basically the pie is not getting larger. So the passive liquidity provider are shrinking their share because they're still getting 30%, but there are not a lot of new investors who are trading. Even if the pool is becoming, even if there are like more liquidity provision, which means that the price impact is lower, still we don't observe a lot of uninformed traders. So if like the sensitivity of the order flow to the depth of the pool is not that large, that parameter zeta u in the model is basically small, that means that the passive provider are basically losing, they are being crowded out because they're getting 30% of a pie which has not increased. And now we have to understand exactly what of this regime happens, and basically the result is basically summarizing this theorem, which says that complementarity happens if and only if this parameter zeta u, which is the private valuation of the risky coin for the uninformed trader is larger than some critical threshold. So this private sensitivity of the order flow is basically pinning down the order flow demand. Larger zeta U, it means that they have a higher private valuation, which means that they will trade more compared to in relation to the pool liquidity. So when the liquidity of the pool increases, they will trade significantly more if this zeta U is larger. And basically, the idea is that we have shown that it could be either one or the other. And then the next question is, how can we mitigate this crowding effect? One potential solution is basically to introduce a two-tier fear system or having more competition among liquidity providers. So the two-tier fear system can be basically designed. This is also informed by some discussion that we had with Uniswap. With Ken, especially, and not with Ken, with Shin and Austin. Basically, the idea is basically the following. Let's try to do the following. Instead of transferring all the fees to the active liquidity providers, when the liquidity provider trades, Lambda, a percentage of this fee is transferred to the passive provider, and a percentage remains to the active provider. So if Lambda is let's say if Lambda is equal to 0, that means that the just-in-time liquidity provider are capturing the whole fee. If Lambda is equal to 1, it means that the just-in-time liquidity provider are basically capturing 0 and all the fees being transferred to the passive provider. So this solution basically guarantees that the passive provider are getting a share of the fee that was previously assigned to the active providers, and therefore they are benefiting from that. And what we can show is that this is basically benefiting the ecosystem and steering the system toward a situation where we have more complementarity and less crowding. And because we are out of time, I will not discuss the effect of competition, but another key point is that more competition also benefit the passive liquidity providers. So if the just-in-time liquidity providers are competing more, then the passive liquidity providers are better off. And I will stop here. Thank you.
Great. I think we might have time for exactly one question, and that's about it.
Yeah, okay, thank you.
Thank you. From the point of view of the just-in-time liquidity provider, you're not the only LP. There's other LP at the AMM. So basically, the efficiency of capital can never be 100%. You're giving part of your profit to the other LPs. So why bother do that as opposed to going to make markets at the order book and provide capital at the best price and reap 100% of your capital efficiency as opposed to whatever share you have in the LP?
Yeah. Okay, so you're saying that instead of like trying to make the pool deeper, and because you're sharing some of your fees with the other liquidity providers, then why not going directly to a centralized limit order book and make the market there? That's a valid question. So here I'm not really looking at, I'm not studying whether or not you should deposit liquidity in one exchange versus the other. I'm just focusing on decentralized exchange and seeing, keeping aside the capital efficiency, which is also a concern that a point that I'm not taking into account, because of course to execute this just-in-time liquidity trades, you need a lot of capital because you cannot use a flash loan, right? You cannot really atomically do this transaction. And this is one of the reasons why we didn't observe yet many JIT attacks, but many JIT trades. But your point is well taken, right? I mean, one could potentially see whether or not it's more capital efficient to go directly to a centralized limit order book. I mean, I just cannot answer this question with this model. Yeah.
Thank you all. And actually, round of applause, please.